As people are joining, what do we got? Cool, awesome. Thank you, Ron. We can see that first slide. But yeah, my name is Ben Walker. I think most of you might know who I am, founder of Inspire Life-Changing Accountants. And I've been really looking forward to having Rowan on our sort of webinars that we do each week or two, because it's such a logical follow-on from a webinar we actually held last week, which was talking a lot around financial control in your business and having a look at the numbers and I guess what means a lot for me having Rowan speak about the whole process of business exits is because that's the logical flow on from taking control in your business is actually making something of the asset you build as a business owner. So that's pretty exciting. Yeah, Rowan, if you could just hit the next slide. Thank you. So just a bit of a background to who Rowan Wood is. I've known him for probably around about 6 months now, but I feel like I've got to know him pretty quick. And some background on why he's called the exit guy is because he's actually exited 9 businesses in the last 16 years, which is pretty impressive. And that's as an equity partner or owner, but he also helps other business owners do the same. So that's 9 of his own. He's also an ex-director of PricewaterhouseCoopers, one of the big 4 accounting firms, and love that you're an ex-director, not a current director, because yeah, there's something about them that might seem great, but I don't love the corporate culture that they breed, unfortunately. But yeah, and in terms of Rowan's background, it definitely is in the context of business valuations. But the other interesting thing about Rowan is also a background in property, both commercial and residential, which is pretty cool. And in terms of the businesses he's helped, if we go to the next slide, there are actually probably some logos some of you might recognise. Like I know Right Property is pretty big in Brisbane. Scody sold to private equity. Pizza Capers sold to various, and then Rowan also sits as part of the strategy or advisory or governance boards of places like EO, PwC. The PA Research Foundation. So pretty cool broad background, which is exciting. And yeah, I guess I've been looking forward to having Rowan on to speak to our clients. And I know we've got a few people who follow us and also some accountants who have joined this morning. But the whole context here is on business exit and doing it, in the way that you can control and appreciate as a business owner. So I might hand over to Rowan if you want to chuck your camera on and take yourself off mute. And yeah, please run us through what you've got to share this morning.
Thanks, Ben. Look, it's great to be here, and Ben, as always, it's great to see you. And of course, Rose up there in the background, she's been fantastic as well. Look, why do I do this stuff? I just absolutely love it. And I think the kicker out of that slide is, I've got a really different mix of, as you just mentioned, the corporate background and certainly in that advisory field. And happily, you'll know that I was one of 2 or 3% of the personality types in PricewaterhouseCoopers, and that's probably why I'm an ex-director. Which led to me being on that path.
Yeah, you don't seem like you're a fit for them.
Well, it was great at the time because I ended up leading up their strategy division, which was just fantastic, which really suited my personality. But I think the big thing in that background is those nine businesses, and I'm just about to acquire another one. Is it's that scale. It's that identify the opportunity. It's what have we got to fix? Where are we going? How are we going to scale it, and what's our exit look like? And look, one of the times I retired and just sold a business, I went and did an MBA for my sins, and I was sitting in this boring lecture listening to this guy, and he said, and one of the things just resonated, and it was just that transition from through that glass ceiling and getting businesses to go to break through that glass ceiling where they're feeling frustrated and business owners are feeling frustrated to go to the next level. And there was this immediate identification of oh shit, that's what I do. right? And as soon as you realize that what your purpose is, everything else becomes pretty easy. So, so Ben, thanks for the opportunity. But today we're going to be talking about, freedom points, right? And why it's important. Now, that first slide there is the all care and no responsibility. Because clearly none of you guys are clients yet, but from a perspective of, look, this shouldn't be considered as either financial, professional, or otherwise investment advice until either you become a client or you talk to Ben, which advice is very good, of course. We'll be looking at a terminology that's quite often used in the share world and investing with regard to risk on and risk off. We'll be working through, right, how to calculate your freedom point. And that's really important. And we'll be looking at personal balance sheets and why your business valuation is so important in your personal balance sheet. It's something as business owners, we either have a wild guess at, we either overvalue or undervalue, and generally have no idea until it comes to that point that you're absolutely frustrated and want to sell. The big talking point, or not so much in Australia, but certainly globally, has been COVID. And we're looking at how that's impacted not only business owners in Australia, but also globally, and why it's a good opportunity to either invest, transition, or exit your business, right? And of course, there's what you want to do next. Okay. To put it simply, right, what the exit guide does is I help established business owners who are feeling frustrated or trapped fix scale and exit their business on their own terms within a 1 to 3 year time period. And that's really as distinct as it gets, right? There's a couple of things that I feel very, very passionate about. Is if we are being and risking our house, our future, our family life, our lifestyle and everything else, I think every business should get an exit on their own terms, right? That's planned, organized, and fulfilling and recognizing that risk, right? Because everything comes back down to risk and return. But too often, and 80% of businesses listed by a broker just clearly do not sell, right? Which I think is just an absolute tragedy. So Ben, and look, one of the things I love doing is being interactive. So one of the things I just want to ask now is if we can go to our Q&A box and just list what your top 3 challenges or opportunities are within the business as we're currently sitting right now. So if we can get everyone to have a bit of a play around with that would be fantastic.
Awesome. And just a heads up to people who've joined, we've also got some polls coming up. So yeah, we want this to be interactive. It makes presenting the webinar much better for Rowan and I, and also ideally you get more value out of it. So yeah, please pop those things in there. So Rowan, we've got Simona, who said good staff is always the biggest challenge, and yeah.
Yep, absolutely.
We got that one. Stuart said growing revenues to support more remote style directors. Interesting, Stuart.
Yep.
Yeah, we had a conversation about that the other day. That's cool. Nicole has said capital to scale and grow. So access to capital.
Yep.
Anyone else? Bob, you got any gems there? Or Stephen? Shari? Good to see so many clients on. Hey.
Okay, so thanks for that. And look, one of the big things is, if we're looking and look at, if we start looking at some of those challenges we've got, staff, right? Invariably, right? When I'm working with clients or, in my own businesses or anything on those sort of lines, or the reason those businesses that I've acquired have sort of hit that glass ceiling, it usually comes down to, time, money, lifestyle, right? And the ability to generate the income that you deserve, Right? And they're the big 3 or 4 kickers that I find that we can link our challenges to. So when we're looking at staff, obviously that's got a massive impact on our time. All right, because we've got to be able to leverage our team and be able to delegate effectively and to utilize the team to drive effectiveness. Right, growing revenue, for remote directors and that sort of stuff. Obviously, that gets linked to money and availability of resource, which is another key, financial leverage within the business. Right, and capital to grow and scale. Once again, that links back into that money sort of side of it. So that's really where we're starting to look at what we can fix or how we're going to scale and what those sort of things and exit looks like. Because and this guy Ben, I worked with this guy for about 12 to 18 months. He came to me and said, "Listen, my lifestyle is crazy. I'm working 65 hours a week." Within 12 months, he was down to 5 hours a week. Purely through being able to leverage his business, his time, and his systems within the business. Right, and fair enough. And when we're looking at growing revenue to support a director, which basically his transition was to become a director rather than an owner and a manager within his business. He basically became a director at 5 hours a week. I think on the bottom line, he was still making a $500,000 profit, but I think that dropped down to $450,000 profit. And I said to the owner, I said, "Listen, do you want your 60 hours back or do you want the 50 grand?" And he said, "Mate, I'd pay another $100,000 to have that freedom that I've got now." And that's an example of that exit. Right.
That's fantastic.
So,
and that's, sorry, just
yep.
you went over that maybe a bit quick there, just that comment at the end, and that's a pretty impressive exit, right? Like,
yep.
in itself, that's an exit of what, 55 or 60 hours a week, to wearing that sort of owner hat. Rather than working in the business. And I think, when people think of business exit, they think, selling and getting a check and walking away. I know that I don't personally relate to that. Because I think, well, what if I sold Inspire? What then? I'll probably start another Inspire. So, at the end of the day, I don't really want to stop doing what I'm doing, but an exit, in a sense, is dropping your hourly commitment to give you that more option of what you want to do with the rest of your week. So I think that's so impressive to think about exit in a time sense, not just a dollar figure.
Yeah, exactly. And what that allowed, and his name was Danny, what that allowed Danny to do was focus that resource, because time is like any other resource, but he was allowed to focus that resource in another area of his life and has now built up another stream of income, which where we're going to lead to now is looking at your personal portfolio and your personal balance sheet, because that's absolutely critical. But you're dead right, because when anyone says, "Oh, listen, what do you do?" And I say, "Well, listen, I help businesses, fix, scale, and exit in their own terms within 1 to 3 years." They go, "Oh, exit, sale, I don't want to sell," and that's only one of 8 options. Right. So selling and actually getting rid of your business is only one of 8 options. But you can look in Danny's situation that he's sort of now got a relatively passive income. But if you look at his hourly rate, he went from 65 hours a week generating $500,000 profit, right, to now down to 5 hours a week generating $450,000 profit. So his effective hourly rates has absolutely gone through the roof, which is then been an absolutely delightful exit.
Yeah. And actually, while we've been chatting, I'll just flag any Q&A with you, Rowan. But Stuart's mentioned exactly my objective by exiting is reducing my hours to focus on ancillary and linked business opportunities. So almost, stuff that supplements the main business. So that is pretty cool. Thanks, Stuart.
And look, I couldn't agree more, Stuart, because the hardest thing about being an entrepreneur and a business owner is actually saying no to opportunities and focusing on the things that matter, right? But when you free up time, there's only so many games of golf that you can do in a day and all those other things. And I've been there. It's great for the first 1 or 2 months, but after you're revived, you're ready. You're champing at the bit again. So. But look, it really brings us to that point, and I've introduced it before, of this balance sheet sort of scenario. And the thing is, when we start up a business, certainly from scratch, All right. It's a little bit different if you inherit a business or you buy a business. But if you're starting up a business from scratch, we don't put a value on it. Right. We invest a lot of time. We're probably learning before we're earning. We're risking the house, the proverbial house. We put some money into it, but it's really, if it's anything like my startups, it's seat of the pants sort of stuff. But as time goes on, you don't put a value on it, right? And and this is a real risk, right? And what happens is, and I'll just ask this question in Q&A, but when was the last time you actually valued your business, right? When have we actually looked at our business as an asset, which 100% it is, but when was the last time we calculated the percentage of our net worth related to your company value? Now, probably never, right? But and the whole point of today's presentation is to start and having a little bit of a different filter and looking at our business as an asset, but starting to put a value on it. So we may, when we start up, and say, listen, we've just started up this business and it's probably worth 1%. We put in $100,000, but all my wealth now is put in our primary a residence, and I've got a retirement fund or a self-managed super fund, which I've got 39% in. So that's pretty standard, right, of how we go along. But lo and behold, what happens within 10 years or 20 years? Ben, so what happens typically in business valuations or contribution to a balance sheet within 10 to 20 years?
Yeah, well, I know when I started Inspire, I don't think I really had a pie at all that looked like that. There was nothing, or anything I did own, I owed to someone else. But yeah, I guess typically we see, after 10, 15, 20 years of business ownership, assuming that there's that the person's not just taking a salary, the business itself makes a profit, we start to see a pretty significant value that gets created in the business. And it depends on the advice that person's got throughout their journey. But, and I think your next slide might make a bit of an interesting point here. But what I see so often is that any money the business makes just goes straight back into the business, apart from bare minimum to maybe pay the mortgage off and chuck a bit into super, which might even be driven itself by tax savings. So that's kind of, if I was to generalize,
look, you're dead right, and that's exactly what happens, and that leads to that frustration and the glass ceiling. And you look back and reflect, and you think, oh shit, I've just spent 20 years, and I've stressed out my family, and the kids hate me, and the dog. I go home at night, and the dog bites me, and you look at your portfolio, and you think, oh, the business still isn't worth anything. But what actually happens, right, is your business soon becomes all-encompassing. And there's an ebook, and I know Ben mentioned this to begin with, but there's an ebook that Rose has made a link for that fills this out and gives a little bit more detail. But the big thing is, as the business progresses to grow, you're getting dividends, you're starting to get leverage, you're starting to get a bit of lifestyle. You've generated relationships, you've generated a lot of goodwill, you've carved out a niche, you've probably got a monthly recurring revenue, all those sort of things, right? You're actually adding value to the business, and then but without you knowing it, right, your business can be 80% of your personal wealth portfolio, right? It surpasses the value of your house, and certainly surpasses your self-managed super fund, right? And I like what Ben said. It depends on the decisions you make, which comes from the advice and the great advice that you get along the way. I get that. But invariably, some years down the track, your business is going to be a massive part of your balance sheet, or your personal balance sheet. And everyone knows the first rule of investing is ensuring that you're in a diverse situation.
And this does not look diverse.
No, and it's not diverse. And I suppose, and this is really where we can bring in the COVID story, is no businesses are bulletproof, right? And no businesses can foresee every single scenario in the future, right? But if you've got a portfolio that looks like this, and you take a massive hit by whether it be a bushfire, whether it be a COVID, whether it be a national, whatever that is, right? You can see it have a major impact on your lifestyle and balance sheet moving forward, righto? So. And looking at Danny's situation, he realised this obviously through working here and with me, and then he then diversified and started to slice that pie up again, which is what you would expect, right? Mm-hmm. But the sad fact is that a majority of business owners, and I was the same, we don't value our business as we're building and creating wealth, right? Mm-hmm. And one of the things we're going to do is have a look at that, and then how it impacts on what we call the freedom point. So if there's any questions, just throw them in the Q&A, and we'll certainly address them as we move along. Okay. So I'm going to introduce some terminology here, and I've got heaps of white papers and the likes. I don't like jargon, which sounds funny from being an ex-director of PricewaterhouseCoopers, but it drives me crazy, right? Because they're obviously the jargon kings. But one of the big things is this risk on and risk off, right? And we've spoken about our freedom point, which really is the point of where we don't have to create any more wealth, where we can actually effectively say, listen, I've achieved what I want to achieve, or I've now got enough wealth within my balance sheet to effectively retire, right? And that's what we call a freedom point. I like to look at it is driving choice, right? I have the ability to choose where I spend my time, choose where I spend my money, choose to go sailing, choose to play golf, choose to go to work if I want to. But if I was to put a name or a terminology on this, I'd put this as the choice point, right? Right now, and one of the things is risk on is if we are continuing to build an asset, or if we're continuing to invest, the return or the risk of that asset, right, won't equate to that investment. And that's what they call a risk on, right? So as you enter this, as our business value increases over time, we will pass this freedom point, right? And the risk supersedes the gain as it's not really needed. And there's a high risk of this decreasing value. So if I went into COVID and I had an 80% of my wealth, of my personal balance sheet wrapped up in my business, and I owned an airline industry, or I owned a travel industry chain, or anything on those sort of lines, right? Immediately, right, you're seeing a high risk of a decreasing value when an incident comes in, right? And you can see if you continue to move up, we don't know where that incident's going to come from. The other thing I like is not only the high risk of decreasing value, but our increase of the 4Ds hitting us also increases, right? And the 4Ds is really divorce, departure, death, or disability, right? And as we get older, and I know, Ben, I can exclude you out of this conversation, but as I get older, right, the risk of departure from this, me departing, death or disability, or one of my key business partners departing, or even divorce increases, right? And once again, if we've got a massive asset within our balance sheet and our personal balance sheet that we're not aware of, that can make an absolute massive hit. Okay. Any questions around that?
I'm keeping an eye on Q&A and chat. So if anyone wants to pop in, I'll flag that with Rowan. But we might keep moving through.
So one of the things is important about this freedom point, or as I say, a choice point, is we need to estimate the income that we're going to need for our freedom. Right now, if we've got a good financial planner, I know that Ben probably has this service as well. It's starting to look at what do we need, what income we need for our freedom, right? Where is our choice point? And it's important. And if I was valuing a business, there's a multitude of ways of valuing businesses depending on the business type, right? But one of those ways is income replacement value, right? And this, in a way, is a part of that. What's the income you're going to need for your freedom? And if I was to put a label on this, it'd really be, what's your income replacement value of your business, right? Step number 2 is multiply that by 33. Now, Ben, I'm going to put you on the spot. Why do you think it's 33?
Well, you're trying to work out if you want that income, how much do you need to hold in assets, earning, and I just worked out the number, 3% a year to provide for your freedom income.
Exactly, right? So that's a really good, and in financial planning terms, right, they use what they call the 4% rule, right? Now, I'm being conservative, and I said, listen, let's make it a 3% rule.
Well, you just took tax out.
Well, I could have looked at it that way. I've taken the GST off the top or anything on those sort of lines. But invariably, it's what they call the 4% rule, right? And we can Google 4% rule, and there's papers available on that. But effectively, it's really what is that that return that we need from our assets that's going to replace our income, right? And then we calculate our wealth outside our business, right? We get an estimate value for your company. We estimate our exit cost, right? We then add on any, obviously, long-term debt on your business, right, which is important, right? And we then calculate what the freedom point looks like. And now, I'll go through this in a little bit more detail, so don't panic, right? From that perspective, I know you're not, but it's also in your ebook as well. I've put there like a frictional cost of selling. A lot of people say, listen, don't calculate what it's going to cost and exit the business, right? So, there's legal fees, there's tax, there's commission-based and on those sort of lines. But the thing is, this freedom point is what your value of investments is, plus the net proceeds from selling your company has got to be greater than your desired income times 33. Right? So if I was being really technical, I'd say, well, listen, actually, it's not 33. We can make it the rule of 4, right, and times it by 22, but we're just being a little bit more conservative.
Yeah. Okay. Cool.
Right.
Cool. Yep.
Does that make sense so far, Ben?
It does, yeah. And I guess one thing we do in our Wealth for Life workshops is we get to what we call a magic number, which is a similar idea, and similar method. As I wrote down my numbers there, it was a lot higher than what my magic number was, and I think that the difference is that return on your investments of 3% being pretty conservative versus what we depending on your portfolio. And I guess that the income's dependent on the family or the business owner. The return on your investment's also dependent on your risk profile and what you want to target there. But I've got a bit of work to do.
Well, and it's better knowing this now than you want to retire next year, right? Because it's that's a crazy time to sort of think, oh shit, I'm a bit short. But another mate of mine, and I race yachts, as you know, Ben, and another mate of mine, he always says, well, listen, how big's your boat, right? And that's one of the things that he says is, listen, how big do you want your boat to be? Will determine on that freedom point or your choice point, or your magic number, right? Once again, to look at that, so and look at Tim here and his freedom point. He's got a desired annual income of $200,000. He's got income coming from other sources that's not impacted in any way. He may have a trust fund that's luckily his parents left him or something on those sort of lines, like a guy, but he gets $40,000 a month from. And he says, listen, my magic number from my own capabilities and everything else is 160,000, right? Mm-hmm. Then using that 3% rule times that, which then he's got some stocks and bonds and everything else. So you take your house value and everything else, and then if we've got any personal debt, which brings Tim's gap to about $4.8 million, right? Using that return rate. Then he looks at, well, he owns 100% of the business. He owns 100% of the business. He's looking at any sort of long-term business debt that he's carrying, right?
He's got to pay that out if he sells.
Yep. Right. Which, well, no, he's Freedom Point. So basically, he's saying, listen, I've got $200,000 in debt there, which effectively has got to go back onto my Freedom Point calculation, right? Which brings his net proceeds required to 4.2 million, right? Less his costs when he exits the business, right? Which, well, I know we said less, but you add all those on, and basically Tim's saying, listen, I really need my entire Freedom Point, my entire number to be about that $5.5 million, righto? Right. So another way to look at it is we get the 5.5 million. We take away our costs of selling. We take away our long-term debt. We look at effectively how much money we need and recurring income moving forward, which would then bring us back to our $160,000, if that makes sense, right?
Goes up further.
Pardon?
Yeah, no, I guess the number I wrote down here needs to be grossed up for the tax, the commissions, and debt. So no, that's again good to be aware of rather than miss that. So.
Yep, and this is in more detail in that ebook. But the overall equation is our Freedom Point, right, or our choice point really is our value of investments less than net proceeds of selling your company or any debt or anything along those lines, and your desired income times 33, right? And that's got to be greater than, right? Now,
sure.
So what that is, then we have choice, right? To sell majority, sell, do an earn out or anything on those sort of lines, right? But the big thing for me really is so important to get a handle on what your business is worth, where the opportunity is, and where the gap and the possible holding risks are moving forward, right? So I think the two main kicker points in there is being able to calculate our Freedom Point, being able then to look at our Freedom Point and value our business, right, which is a part of our assets, a part of our wealth creation, right, to have a look at that wealth creation model and value our business and include that in our wealth creation value model, then we effectively do the calculation and saying, well, is this less or greater than the money that we need?
Yep, absolutely. And I think unless we've got some very impressive sized businesses here, I think we're going to find that we need to do a bit of work there.
Well, look, once again, it comes back to how big your boat's going to be. But
what's the answer to that, though, Rowan? Isn't it 3 feet bigger than your current one?
Well, it's always bigger than the current one, but but the thing is, for me, you always want a new shiny toy, but the reality is, I've pared back my Freedom Point. I know where it's at. Luckily, I don't carry any debt or anything on those sort of lines. There's the passion that drives this for me, right? But it's really what's that lifestyle moving forward, and can we set it up, and is the business valuation a part of that contract moving forward? And if you look at that website, I know you've made this available to your participants today, Ben, but I use a very simple valuation tool called the Value Builder System. They've surveyed around 55,000 businesses. They benchmark the business. They use a combination of valuation methodologies. Right now, I wrote a big couple of white papers where I ended up with a useless medal from the University of Bond or whatever, which you'll never use, but so valuations can get quite technical and quite onerous, whereas this one here is really quite simple, but it really brings into the opportunity of the business, the risk of the business, how it's growing. It looks at all the dynamics of what makes businesses attractive and gives you effectively a score and a valuation. And I find it really, is it technical? No. Does it suit all businesses? No. But does it give you a good indication? Absolutely, yes. right?
And I love it. It kind of, it gives you scores on sort of different areas of risk in the business. That's what I like about the methodology behind it.
Yeah, look, it does because, and look, everyone uses the capitalizations of earning methods, for example, and which is just a multiplier of a market value or a market multiple, right? And what they're saying is, listen, here's your EBIT times a multiple or a risk factor of that business moving forward, right? And therefore, that's what the value of the business is. Well, that doesn't work in all situations, right? But all that multiple is a risk, right? So if you own Subways, for example, 10 years ago, right, you're probably getting a multiple of 6 or 7, right, on EBIT, right? Because I was seen as a really good investment with low risk and sustainable income. But now I was talking to a broker the other day, and Subway is back down to around 2%, right, in the current marketplace, right? So, but that's an indication of risk of Subway right at the moment in the current post-COVID environment, right? Yeah. So you're dead right, but this does give you a score on the attractability, and a part of that is the risk or perceived risk within the business, right? Sure. So. And that's yeah. Sorry, Ben, you go.
Yeah, the link to go and get to do that questionnaire to get your score is in the chat box as well. Rose has just posted that in there, and Rowan, it does, like, you put some sort of high level numbers of your business in there, and it gives you a potential value.
Yeah, it does. I only release those numbers really to my clients, or in your situation to your clients, right? Because they take some explaining, right? And there's caveats around it and everything else, because it is a simple valuation, but it is quite accurate, right? And I like to release it, but the big thing is it shows not only the estimation value now, but it also looks at your potential value or where your improvements can be found, right? When it comes to looking at basically making your business attractive for an exit. And, the big thing here is that exit could be effectively, like Danny did, was just get out of his business, right? That was his exit, but he still had to go through this process.
Yeah.
Right?
Yeah.
He still had to effectively look at that potential value, and his potential value of the business went through the roof because his key man risk decreased dramatically. And then when that did it, his valuation went through the roof.
Yeah.
So
that's it.
So the next kicker in the world, and the big thing I've been speaking about for the last 18 months or 12 months is COVID, right? And everyone has. And
feels like 18 years.
Oh, mate, it does. It is crazy stuff. But look, and I just read a report the other day on business confidence within Australia, transactions within Australia, merger and acquisitions within Australia, and everything else. And I wouldn't want to be anywhere else in the world, right? So,
absolutely.
And I'm really going to be interested to see what everyone's feedback is on your polls, because what we're going to see now is really how COVID impacts, right, your freedom point, right? Because clearly, as we've just seen, there's been a massive adjustments in valuations. There's been massive adjustments in sentiment. There's been massive adjustments within confidence. There's been massive restrictions within travel, and our whole way of doing business has changed, right? And those businesses that haven't been able to, and I hate that word, but pivot or anything on those sort of lines, will be able to take advantage of it, right? As people have had massive impacts on their freedom points, right? And that's what we really want to have a look at now, right? So I don't know whether it's a good time now to put in your first question.
Yep, we're fired up already. There we go.
Okay, great.
So the first question we're going to ask to people who are joining is, what do you expect your revenue to do in the next 12 months? So increase, stay the same, or decrease? And wow, can you see those results so far, Ron?
No, I can, and I've just said the host and panelists cannot vote, so I can't see them.
All righty, so I'll just leave it open for another sort of 5 seconds or so for anyone else who wants to pop in a vote. So very, very interesting. share results. Cool. So so we had 12, 13 people vote. 9 out of 13, or 70%, expect an increase in revenue. 23% stay the same, and one person, or 8%, is expecting a decrease in revenue. I guess overall, that's fairly positive given what we've just been through.
Well, it is, and it also reflects on what the stage we are within COVID as well. Right, so where our business confidence is gone through the roof. We've never seen cheaper money. Our availability to cash is great, and the government incentives have gone absolutely through the roof to prop up businesses, which will change by the end of this month. I get that, but that doesn't surprise me. But let's have a look at a poll that was done with a larger cross-section of around 20,000 businesses, right? And this was globally, right? We can see there that there's been a dramatic increase in the number of small businesses who expect their revenue to drop in coming months, right? So this was done in the height of COVID, right? And and this is still relevant in some of our major trading partners and major economic areas of the world, right? So if you're a business owner sitting in the middle of London at the moment and you've got deserted streets, if you're in the middle of the US, or anything along those sort of lines, that would be true and correct. The next poll, please.
Cool. So the next question here is, if you were considering exiting, would you? And there's 4 options here: sell my business to a third party, shut down the business or no sale, transition to the kids, or management buyout / employee purchase. So I'll just leave that open for another 10 seconds. Not as many people voted here. If you do have an answer separate, if you pop that in the Q&A box. So if none of these 4 are resonating, then just pop your response in the Q&A. All right, 5 more seconds. Thank you. So we've had 64% sell to a third party, followed by management buyout or employee purchase, 29% there, and transition to kids, 7%.
Okay, righto. So that's once again, I think that's pretty reflective of the Australian environment, without a question. Right, I'm pleased to see that there's no shut down the business and just walk away. Why am I pleased to see that? Another one of my clients, I had a discussion with him before he started in my exit room. All he wanted to do was walk away with effectively and sell his stock. Right now, admittedly, his stock was about $400,000 and he had no debt on it. But he said, if I could just sell my stock and walk away, I'd be happy, right? And I said, if you're going to sell your stock, you sell it to me and you sell the business at the same time. I'm happy, right? And at that stage, we did that valuation and it came out about 1.1 between 1.1 and 1.4. Worked with him and we closed that sale through COVID at 1.4 million, right? Including stock. All right. So effectively, he got $1 million cash, right? And the biggest thing I worked on with that business owner was yes, your business is worth something, right? And we're not walking away, right? So let's have a look at the results. If I can just use that, right? So the big thing about this is people, right? We're basically saying, I'm not going to transition it to anyone that I know, right? Because it's been bloody tough work through COVID, right? With the uncertainty, our cash flow impacts, our reliance on government funding, JobKeeper, our inability to travel, our energy needed to reinvent ourselves is too much. If it happens again, I don't want my kids or anyone I know saddled with the business. I'm going to sell my business to a third party. Right. So I think those sentiments are reflected there as well. Ben, next question.
All righty. Number 3. This is a bit of a different question. So it's what is your definition of wealthy? There's three answers. And again, if none of the three are resonating, pop your other into the chat box. But we've got a minimum of $10 million in net assets, if that's wealthy to you. The second one is having enough money to cover your monthly lifestyle expenses. And then the third one, having enough money to do what you want when you want. So just we'll leave it open for another 20 seconds. If you can pop a response in. Let's make this our biggest responded questionnaire. So anyone who hasn't voted for an answer yet, if you can just pop something in. Something's better than nothing.
That's too funny, Ben, because one of my rules usually is if I'm running a group or any of that sort of stuff is what you put in is what you're going to get out, you know, and it's basically, you know, the way you participate is usually the way you run it.
Yep. And actually, I can see some double ups in attendees, so that might be a second. I don't know. So I don't know what's going on there. But actually, this has been our biggest responded thing yet. So,
yay!
All righty. So share results. Clear winner is having enough money to do what you want when you want. Followed closely by 10 mil or more in net assets. Yep.
Okay. So that pretty well mirrors that questionnaire that went out to, I think, about 20,000 people. Once again, it was in the mid of the pandemic, right? But basically, it says, you know, that our definition of wealth has changed as well, right? And what's that saying is, you know, business owners, they just want to do what they want to do, right? And when they have such a large chunk of their portfolio of their investment taken away from them, or, you know, an unforeseen risk or an impact that they can't control, there is nothing more than demoralizing, right? And it doesn't matter whether you've got a 6-foot boat or a 60-foot boat, right? But you still want to have enough money to do whatever you want when you want, and I think that's the importance of that freedom point calculation, and then calculating that your business value and taking that into consideration. So that's a good one, right? So well done on that, and if we can get the same participation for the next question, it'll be really good as well.
That's it. All right. Question number 4, and this is our final one. We've got, how long do you intend to run your business for? So 2 to 5 years, 5 to 10, or more than 10 years. All right. Cool. We're about halfway there. Half the responses so far. There we go. A few more. Come on.
It's like watching a kettle boil.
That's it. We've got maybe 2 or 3 more responses. You know who you are.
Now, I hope Rose isn't participating and swaying our results.
I think panelists, I can't even vote either. So I don't know.
No, I can't vote either. Otherwise, I'll be clicking away like no tomorrow.
Just answer them all. All right. So what we've got is clear winner is 65% saying 5 to 10 years, and then an equal spread for less than that or more than that.
Yep. So what happened during COVID is, no surprises, but everyone sort of said, listen, I want to get through this, right? I want to recreate my wealth again, and I want to exit. Right, it's just, you know, I haven't, you know, and the time frame of retention has dropped, right, which I think is reflective as well.
Absolutely.
Yeah, and they're the type of horizons, you know, within 2 to 5 years, 5 to 10 years of prolonged effort. You know, putting your house on the line, you know, creating wealth through your business. Right, as long as it's sustainable, and as long as we put a value on our business moving forward, and we do that within a balanced portfolio sort of scenario, those results obviously mirror what we've seen in that survey as well. So look, a few surprises on that first one, right? But everything else sort of, and I think that's more a reflection of Australia and being Australia specifically in our economic environment here. But really, even the post, because the latest thing is the post pandemic environment, right? We're starting to see that there is there's one certainty, right, is the assumptions of the past really no longer apply, right? So we are seeing economic stimulus like we've never seen in this country. We are seeing money as cheap as it's ever been, right? We're seeing lazy balance sheets, and I know, Ben, you would work on lazy balance sheets and making sure that equity within business is making money for business owners, and it makes sense if you're getting a 10% EBIT or 15% EBIT within your business, and money is costing you 1%, and you're sitting on a load of cash. Well, what's going on, right? A few shifts, uppercuts there, but the assumptions of the past really don't really apply moving forward, right? So good chat around COVID, and I think once again the latest research I've seen is there's no better place and there's no better time, right, to be looking at your business objectively, looking at your valuation of your business, and looking at your exit seriously, because money is so cheap, it is looking for a place to hide and to generate income over and above cash rate. Right. And therefore, what's happening is, purchases and acquisitions and mergers are happening right now, right at the moment. And it's one of those things we should be looking and putting on our radar. So, Ben, I don't know whether you want to do this recap.
Yep, no worries. So, so thanks, Rowan, for running us through that. And yeah, I guess one of the things I want to ask in the Q&A box is what's been the biggest takeaway, or maybe takeaway, but also thing you're going to do as a result of what Rowan shared this morning. And just to run through, we cover what the freedom point was. So working out, how much in net assets do you need to, fund that lifestyle, and the gap between what that needs to be and where it is. We spoke about risk on or risk off, and making sure, do you really need to go past what your freedom point is, and those inevitable, one of those 4 Ds is going to happen to everyone, which is death. We will. That's what we're guaranteed. Death and taxes. We worked out how to calculate the freedom point, and the back of the napkin of that one is your lifestyle income times by 33. We'll get that number, and then you need to gross it up for taxes and commissions. Is one of my taxes takeaways were. Then having a look at your business value relative to your total portfolio, and a couple of those things we want to keep in mind is make sure it's diversified, it's not too big, but also if it's too small, you need to also have a mind to growing that as well, because as business owners, that's usually one of our biggest ways we can impact our family's wealth is growing our business value quicker than what we could in other assets. And then, we covered through those polls a bit of a sentiment for what COVID's done, which is, positive compared to the rest of the world. So that's a bit of a wrap up. And I guess from here, I mean, I've got two things I can kind of sort of suggest for attendees. The first one is having a better read of that Freedom Point ebook, but also the sellability score. I think that the process of that will just help you identify, I reckon, some low-hanging fruit or some areas of the business which, if you did a few things to de-risk that area, may have a dramatic impact on your, on the value of your business, or at least if you're valuing on an EBIT model times a multiple of your profit, it might help up your multiple, which is a pretty fast way of growing your business value.
Yep.
Wow.
I love that, Ben. And look, one of the things, and I often say to my business owners is, there's a lot of uncertainties in business, and one of those uncertainties is how we're going to exit and when we're going to exit, right? But one of the absolute certainties is that you will exit your business, and you will exit it, right? But whether or not it's on your own terms or not, that remains to be seen.
Absolutely. Very good. All righty. Well, thanks, Miriam. So Miriam said her takeaway was reevaluating your saleability with COVID. Yep, good point. So what's your COVID have on the value of your business?
Well, yeah, for me, right, we're seeing some very positive transactions, right?
Cool.
And you know, I kept my business, even though I'm a licensed valuer and broker and all that sort of stuff, I don't transact businesses on behalf of my clients unless they ask me to get involved. Couple of businesses through COVID wanted me involved, and mate, there were some dire times. How we kept some of those contracts together is beyond me, but effectively we transitioned the business, and they are just booming. Right, from that perspective, we're seeing transactions and valuations be more on the positive side rather than the pessimistic side, from a perspective of surety and attractiveness around income and income flow and returns. We're certainly seeing that. On the flip side of that, businesses that aren't ready for sale or represent a high risk, right, or are uncertain in their direction and strategy, right, we are seeing massively discounted in the market. So, yeah,
for a buyer.
it is, right. And look, I just don't know whether I've got the right slide here. Just bear with me for a tick. Yeah, I have got it here, right. Just bear with me. So I'll flick that slide up. But so we're seeing, and you can look at businesses at the moment, and look, this is just using a very rule of thumb of capitalization of earnings model, which is majority of businesses in our lead will be looked at, right? But we're seeing businesses down in this area here, right, that haven't got leverage worked out, haven't got an alternative stream of income, don't have monthly recurring revenues, don't have a strong management team in, too reliant on the business owner to create wealth, and those businesses in that area there are transacting very low, right? And that's a direct influence of COVID, and that probably the businesses in there have probably increased a little bit, right? So, however, the businesses up in this area here where there's a clear strategic fit or positioning, or in this area here, right, where it's got good, strong balance sheets that are working hard and there's a track record of good return on investment, are selling exceptionally well and pushing up, right? So they're pushing up, right? Whereas the ones down here are obviously are stagnating in valuation and just leaving there behind.
Yeah, and that's
does that make sense?
Yeah, no, definitely. So, and that's a very simple illustration. So, $500,000 in profit for this business, or EBIT, and you sell it 2 times multiple, you get $1 million. You add that layer of strategy, you get 4, and again you get 6. So the result is $2 million apart for potentially the same profit. Just a better purchase for the person buying you.
Yeah, because good money wants a good place to hide, and if you've got a good place to hide, you'll transact, right? Without a question.
How good.
Yep.
Very cool. All righty. Well, that brings us to time, and just want to thank you on behalf of our attendees as well. But thanks for sharing your knowledge with us, and I'd just love any feedback if you've got it, or a thank you in the comments, and appreciate your time, Ron.
Yeah, Ben, it's been absolutely great working with you and Rose, and I know you've put this on behalf of your clients, and all associated costs and everything else, and certainly with that valuation and that report and everything else, and I think once again to reiterate, if you do only 3 things: work out what your freedom point is, read through your ebook, and click on that and do that 15 minutes thing. At least it's going to give you a starting point.
Yep.
Righto.
Perfect.
Okay.
All right. Thanks everyone for joining. Thanks.
Cheers, Ben. Cheers, Rose. Bye-bye.
Awesome. Thank you. Have work to do now. Awesome.
See you, mate. Bye-bye.
Bye.